Hey everyone, welcome back to AWM Insights. It's your Power 3, 2 CPWAs and a CFA. We are Eric, Brandon, and Justin. Everyone's heard the comment, it doesn't matter how much you make, it's what you keep. We've heard this 1,000 times and everybody would agree that we all want the most amount of money in our pocket. And this holds true when it comes to your investments. It's not your gross returns, which means before tax, that matter. It's actually your net returns after tax. This is the money that hits your pocket that we can actually eat off of. Yet, for all the disdain that we see towards taxes, the majority of investors' portfolios are rift with high fees and expensive taxes. And you may ask the question, how important is tax planning when it comes to your portfolio? As an example, if you're a California resident, I just want to walk through some of the taxes that you pay here. 37% at the top federal rate, 13.3% at the top California state tax rate, an additional 0.9% Medicare tax on top of that. And then you're lucky at tax time, if you're in the highest tax bracket, you're going to pay an additional 3.2% on your investment income. And so we're talking about 50% of your potential return can be eaten up by taxes. And you may ask the question, well, why do people not have more tax efficient portfolios? And the reason is because Wall Street serves the mass affluent, and only 0.1% of singles and only 0.7% of couples in the United States are actually in the highest tax bracket. And so we deviate quite a bit from Main Street financial advice here at AWM, where our focus is on capturing the highest expected returns and maximizing your after-tax returns. And so today we are excited for a conversation with a special guest, Alan Trice, the head of advisory services at Gurtin, which is a specialist municipal bond manager that focuses on maximizing tax-exempt income for high net worth individuals. For you guys that don't know much about Gurtin, they manage over $50 billion in municipal bonds. They've got 65 firm-wide credit analysts. They've got 30 plus dedicated people on the muni bond team. And so with that, let's welcome Alan to the podcast.
All right, Alan, thanks for joining us. How you guys think muni bonds fit into an overall portfolio?
Sure. And thanks for having me on, guys. Really appreciate the opportunity to speak with you today. You know, when we think about how fixed income in general fits into a portfolio, I think there's really two purposes for it. You know, the first of it is to provide, steady and consistent income. But more importantly, we see it as providing kind of a ballast in the portfolio. You know, it's there to provide safety. It's there to provide diversification from equity risk. It's that part of the portfolio you really don't want to see ever having losses within it. And when you have big drawdowns in the equity market like we saw last spring, you want this to be something that you can go to without fear of really taking big losses on that portfolio. So when we think about muni bonds more specifically and why they, meet those two criteria really well, I think on the first point, in terms of income, they're extremely tax efficient. Almost all munis are completely exempt from federal income tax rate. And most munis that are issued within a certain state are also tax exempt for taxpayers within that state. So for instance, if you're in California and potentially paying, upwards of 54% in taxes, if you buy a California municipal bond, it is completely free from income tax. On the second part, in terms of providing safety and diversification, munis historically have been extremely strong in terms of principal protection. If you look at historical default rates in the muni sector, the total default rates are measured in basis points. If you look at them compared to corporate bonds of the same letter grade, so, for instance, comparing a AA muni to a AA corporate, the historical default rates have been fractions of what you've seen in the corporate market. So it really is a sector where you can be highly confident that you're going to get paid back your principal and your income at the end of the term of your bond. And then lastly, they do provide a significant amount of diversification away from equity beta. Typically, you see negative correlations within the muni market to equities. And what that means is that typically when you see big sell-offs in the equity market, not only are your muni bonds holding up really well, but frequently they're actually going up in value when equities are going down. And that's exactly the kind of trade-off that you want to have within your fixed income portfolio.
Oh, that's excellent insight. So high credit quality with tax efficiency and sometimes tax-free income. It's a great combination. And then combining that with the diversification benefit, as frequent listeners will know, is really, really important to us. Let's dig a little bit deeper within the muni market. What's unique about this space and the market specifically compared to equities or even compared to other fixed income markets for that matter?
Yeah, that's a good question, and there's actually quite a lot that is unique and different about this market. I think first, if you just look at the size and the breadth of the market, there's over 50,000 unique issuers in this market. There's over 1 million individual QSIPs. If you compare that to the equity market, there's something like 5,000 total issuers in the equity market, and the total market cap, the dollar amount of that market, is significantly bigger than the muni market. So there's just a lot of diversity within this market. Second thing, it's retail dominated because of the tax exemption that is provided by munis. About 80% of the market is owned by retail investors who pay taxes. And what that means is that there's really no institutional research. If you think about all the research that gets done on equities, the number of analysts that cover them, the number of bloggers who are covering, an Apple or a JP Morgan, you don't have any of that in the muni market. You don't have quarterly updates. There's no management conference calls and those type of things. And then, the way that the revenue streams work for this market is very different from a corporation as well. I mean, if you think about governments, their powers are very different from what you see in the corporate market. They typically have highly inelastic demand for their services. They have heavy taxing authority, and they generally have sovereign powers as well. I mean, if you think of a state, for instance, a state basically has all of the same powers that the federal government has, with the exception that they can't raise an army and they can't print their own currency. But beyond that, they can basically do anything that the U.S. government can do. And then if you think about, the worst case scenario of going through, a bankruptcy in the muni market, you can't liquidate a city or a county. It's very different from what happens when you go through bankruptcy in the corporate market. And so there's a lot of differences that come back just because of the nature of the market and the government backing. But then that leads to another aspect of it. I think people typically think of munis as really being government debt, but it's a highly diverse market. Only about 30% of the total municipal market is general obligation debt. And much of the market really isn't even what most people think of as a municipality. Not-for-profit healthcare centers and hospital systems, universities, both public and private, public housing, even things like industrial and economic development bonds can issue within the municipal market and make up a really large percentage of it. So there's really a much greater amount of diversity in this market than I think a lot of people realize, and makes it a lot more difficult market to analyze at the end of the day. And then I think the last thing I would mention is more on the structural side. You tend to have a very different way that bonds are structured in this market. First off, about 70% of the muni market is callable, meaning that the issuers have the option to call away that bond at par prior to the final maturity of the bond. And they're also typically issued with premium coupons. And so even though, today in the prevailing interest rate environment is closer to a 1% to 2% rate environment, you typically are still seeing most longer term bonds issued in this market with 4% to 5% coupons, which is just part of the convention within the market. If you look at the treasury market, the corporate market, or other parts of the taxable side of fixed income, they typically issue what we would call market coupons, where the coupon is very close to the underlying yield on the bond. Very different in the muni market, and again, can lead to a lot of issues in terms of analyzing structure and value in the market.
Wow, and that was definitely a good deep dive there. I think, I've heard a couple things that I thought were kind of interesting, and it's a good segue here to a part of the podcast we typically call the average Joe versus the pro. From the average Joe perspective, I heard, that this is mostly dominated by the retail side. Obviously, we've got the tax benefits. So, why not just, pop into my retail brokerage account and pick some munis? That sounds like a pretty good idea. But then on the flip side, the pro and me sitting there saying, hey, this is a pretty complex market and it might not be that easy. So I'd love to hear from you, what's your advice if I'm the average Joe, I'm the guy sitting here and it all sounds really good. Why turn to the professional as opposed to just going and buying some munis on my own?
Yeah, I mean, I think, we typically think that this is a pretty misunderstood market and generally wouldn't recommend individual investors investing directly on their own within this market unless they really have specific knowledge and experience trading this market. And I think the first thing is supply. This is a completely over-the-counter market. And so it's really hard to find bonds. And even if you're going into your custodian and they have a decent inventory that you can choose from, it's going to be a small fraction of what is available in the total market and what a professional investment manager would have access to. And those custodians are typically going to charge pretty big markups to sell those bonds to you. So the trading cost ends up being pretty high if you're trying to do these on their own. The second thing is just transparency. This market is notorious for being very difficult to look at the issuer's name and really understand what's happening behind the scenes. There are a lot of issuers out there that can be backed by a number of different revenue streams, whether you're going to be subordinate or senior within that credit structure, all these kind of different nuances and aspects within the bonds. If you don't really know what you're doing in this market, you're likely to miss some of that. And you could potentially make a pretty costly mistake by buying something that is not exactly what you thought it was. And then I think, we think about once you've bought the bond, the next most important thing is watching that bond on an ongoing basis. I think, Warren Buffett is known for saying that he likes to put a whole bunch of eggs in a basket and then he watches the basket. Well, who's going to watch that basket for you when you buy that bond? If you buy a 10-year bond, there's a lot of things that could go wrong over the course of those 10 years. And we really think that you want to be watching those on basically a day-to-day basis to make sure that you're cognizant of news flow and what's coming out. And then I think, beyond that, there's a lot of additional benefits that you can get from a professional manager. I think, one of the biggest benefits that they can provide is providing commentary when there's a lot of news flow out there to suggest that there are problems within the market. Just over the last 6 months, you can't go a week without seeing a big article in the Wall Street Journal or in Barron's about, how revenue is suffering at municipalities. Some of the drawdowns that we saw in the spring, you could end up selling at exactly the wrong time if you don't understand what's really going on at the underlying level. And then there's additional benefits that you can get from a professional manager, like tax loss harvesting, that are hard to quantify, but can have a really big benefit on the bottom line. So I think ultimately we feel like this is a market where a professional manager is not only going to do a good job of kind of mitigating the risk and making sure that you are meeting those initial needs for your fixed income portfolio that we discussed at the outset, but they're also going to have a better ability to maximize the return in your portfolio over time.
I think that's huge, Alan, and thanks for those thoughts. I mean, it brought me back, and Eric, definitely, I think we'll have this sentiment, but to our days being at one of the big wirehouses and watching some brokers that, quite frankly, probably underperform the average Joe, but play that game, trying to go from an inventory perspective, and it can go wrong really, really quickly. So, what a great insight there.
Alan, thanks for sharing your wisdom and knowledge with us. As Brandon said, to piggy off, that is really beneficial for us to hear the importance of having a professional team behind your portfolio. And for the audience and the listeners, we know that you guys have worked extremely hard for the money that you are putting into your portfolios, and that we're trying to grow this, right? Not just for the sake of growing money, but to be able to achieve priorities and outcomes. And we want to make sure that you guys are capturing every dollar that you deserve, capturing the returns after tax that you deserve. And so what we're doing is we're hosting a free webinar for you where post-election, we're going to break down what are the implications for your portfolio based off of who our president is. We're taping this on election day that's being released, so we have no idea who the president is, but we know that taxes are going to matter. So head over to awmwebinar.com. Once again, that is awmwebinar.com. And until next time, stay humble, stay hungry, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.